Hi, everyone. This is Jason Brack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. I'm excited to have him back on. It's Gordon T. Long. He's worked in private equity, and he worked as a Fortune 500 executive, too. And he covers the economy just about as well as anyone on YouTube with all of his interviews of financial experts specializing in financial repression. So thanks for coming back on, Gordon.
Jason, thanks for having me. Enjoyed our conversation last time.
Yeah, I did too, and I think so did our listeners, so that's why we wanted to have you back on, especially with the announcements that we've just been seeing in the global economy. There's just been so many exciting current events. So we're going to talk about oil, and we're going to talk about the Swiss Gold Referendum and things like that. But first, for listeners who haven't seen any of your work and who didn't listen to our first interview about financial repression, what's a basic definition of financial repression? What's your definition of it?
Well, I've interviewed probably 20 to 25 people and asked them what their definition is. And I've found that there is nobody who's got a real clear definition of it. But the one that I've come up with, and let me use some key words in it, is financial repression uses a combination of inflation and government control of interest rates in an environment of capital controls to confiscate much of the purchasing power of the nation's private savings. That's how I define it. In layman terms, Jason, financial repression is government stealing from savers in the future. That's what's going on. And I underline the word stealing because it's covert, it's not above board, and in fact, in many ways, it's dishonest. I'm not saying the government doesn't have to raise the money, but they could be a lot more forward with the approach that they're taking.
Exactly, and it's not like the voters are having a chance to vote on a 10% per year tax increase or something like that. So that's why you're saying it's covert instead of the voters having a chance to do this, or people in Congress saying debating this issue or something like that. None of these options are on the table. It's just being done by these Keynesian central planners on our behalf because they think they know best how to run the economy. And, it's basically to the point where the government has decided we're going to get our funding at all costs. You called it theft. I guess it's theft, but the wealth that is stolen, it doesn't disappear. It doesn't disappear down a black hole. I would say it's just more transferred.
It is, in fact. That's one of the misconceptions, Jason, is people don't understand that, in fact, it is wealth that is transferred. It's not lost. And it's being shifted from savers to borrowers and highly leveraged individuals or companies or corporations. And when you have a government by the people, for the people make decisions on how money should be raised, government should be funded, what the fiscal amounts should be within certain guidelines. But what we have government by the government for the government, and that is what I find offensive about it, and the whole approach, because it's so covert in its way. Now, this is in a way it's been implemented. Now, this is not something that is brand new. This has been done many times. In matter of fact, was done after the Second World War in the United States through about 1956, quite successfully and hardly noticed at all. And what is it that they did? Well, you have to understand that financial repression involves negative real interest rates. It involves regulations and laws that limit your abilities and options to move your money around. It involves ring fencing in that regard. It involves a forced level of inflation into the economy. And the fourth one, and maybe just as important, is elimination of warning signals so that people really can't see some of these actions. For example, manipulation of gold prices, manipulation of inflation numbers, manipulation of deflator numbers in the GDP, et cetera, et cetera. Any of these things you think we have?
Yeah, we have all of them.
Exactly.
we have all of them. I mean, they're basically following the blueprint almost exactly that Ray Dalio wrote in his beautiful deleveraging paper. I read that white paper, but before that, Carmen Reinhart. I think the first time I ever heard. Are you still there?
Yes, I am.
Okay. The first time I ever heard about financial repression, I think, was a couple years ago. It was in a government white paper, I think, from Carmen Reinhardt.
Correct.
And it was talking about how the nominal GDP growth needs to be more. It was, academic Keynesian gobbledygook that the nominal GDP growth needs to be more than nominal interest rates and things like that. That nominal interest rates need to stay down, and we need to have nominal GDP growth to to get the wealth effect going and consumer spending going and things like that. So I think all these things fit into, like pieces into a puzzle. So I call it, financial repression is part of this worsening stagflation where the central planners in Japan, in Western Europe, in England, in the U.S., they think that they can control a certain amount of inflation. They want to use the wealth effect. They want to use all these different types of policy measures to get the type of economy that they think that they need to appear to grow, to appear that there's no inflation, that unemployment is low, that GDP is actually growing, et cetera, et cetera.
And every one of these numbers, I think you would agree, are somewhat manipulated, if not terribly manipulated. You mentioned Carmen Reinhardt's article, or papers that she put together for the Economic Council, and she started putting these papers together, even 5 or 6 years ago. But initially, this approach was referred to as a debt liquidation tax. And they quickly started striking out that terminology because that's what it's about. And I was reading the other day in the Financial Times, you may have seen the same article, Jason, and it was Britain was quite excited because it had finally paid off, at least the article was saying, that it paid off the debt from the First World War, a total of $2.3 billion, and additionally was paying off the debt from the South Sea bubble, which, if you recall, was like 1770 something or other, so that they were paying them off. And I thought, now, isn't this interesting? But they're not really. They're just rolling it over. So you have a $2.3 billion debt, which almost brought the world to its knees because of the amount of debt accumulated in the First World War. But by rolling it over all of these years, now $2.3 billion is almost insignificant, right? It's meaningless. And the total, excuse me?
Well, in today's dollars, Gordon, from the World War I, right, $2.3 billion would be like 100 times that amount, right?
At least, exactly the point. So the total payments of the interest payments that have been made on it are about $5.6 billion. But they have depreciated, devalued. They have, through fiat currency, the sterling, so that in fact it's next to nothing. And now they're not really paying it off. They're just rolling it over at cheaper rates because the interest rates are so low. So we know that the United States, since we've had the Federal Reserve, what a dollar is worth now compared to that. So we all understand how inflation totally destroys our purchasing power. But here's an example of how the governments really don't worry about budgets because they just see that they're going to inflate them away. What happens, though, Jason, is when our deficits get so large, inflation isn't working fast enough. Matter of fact, the amount of money you're pumping out isn't creating enough wealth. Your propensity falls off. So what happens then is you have to accelerate the process. And to accelerate the process, you not only have to have inflation, you have to have negative real interest rates. And herein lies the rub, because all of a sudden you can't quite get the inflation because you got so much debt, non-performing loans, and this deflation starts to creep in because of malinvestment, unintended consequences, moral hazard, mispricing of risk, lack of price discovery, and I can go on. All these things start to come in. But that's what financial repression is. Financial repression is this kind of the final game where they have to really they have to steal faster from you. Okay. And think of, I have a lot of friends. I'm older than you, Jason. I have a lot of friends of mine that are retired, and they retired where they thought they had a substantial amount of money, and they're being forced to go back to work. I have a friend of mine who was a dentist, sold his practice, and he came to me the other day, Gordon. He said, I had planned on 8%, but I conservatively took 6%. And back a few years ago, wealth managers said, look, I know you can make 8, 9, here's what you can get on your bond, but plan on 6%. He planned on 6%. Now, do you know anybody that's easily getting 6%, Jason, right now? Without undue risk.
Not in the mainstream. The mainstream financial planners, the regular people who work in the financial services industry, they don't know how to really adapt to a scenario like this. So if they are trying to get 6%, they're in junk bond mutual funds or things like that. They may have bought shale oil debt.
Right.
So yeah, they thought that they weren't, they may not have realized the risk they were taking on, but they were, reaching out for yield.
And everybody chased for yield. So my friend, the dentist, suddenly has got to go back to work. And he found out that he can't even practice dentistry because what's happening now is the malpractice insurance is so prohibitive as a standalone, even part-time work he can't do. So he's going to have to work in retail. What happened to his life? And I'm just giving you the kind of example. So if you had somebody that had, let's say, $500,000, had planned on 6%, that was $30,000 a year that they were expecting with Social Security to live on. Okay, and so to save $500,000 back through the 60s, 70s, 80s, you had to be frugal. So you've done everything. Now all of a sudden, what kind of interest rate are they getting without any kind of high risk? 0.5%, 1%? So now they're getting a couple $1,000. They can't make it. Now all that money, where did it go? They're not getting it. But in fact, Jason, it's been transferred to the government. And what I find is that people don't understand how that transfer of wealth really works. And is this valuable to explain this part, Jason?
Yes.
Because the wealth, people don't understand what wealth is. That's what I have found. And how to store wealth. Money, paper is not wealth. It may have been when it wasn't a fiat currency. It doesn't store it. So let's assume for a moment that an ounce of gold we consider wealth. Okay, I'm not going to talk whether it's a value, but it's an ounce of gold. So if you've got it, we consider it wealth. Now, what is it about the gold? It's purchasing power. That's the value. No matter what you think the wealth is, it's something that you have that other people want, and you can exchange for something else that you may want. That's wealth. It stores this purchasing power. So going back to my friend the dentist and the $500,000 kinds of investment, they have stolen your purchasing power. Your money doesn't get in. You don't have any buying power that's falling off. But the government, on the other hand, is printing the money, and the first-time user, they have the purchasing power. And they're going out. And by the way, the money they're even the money they're taxing from you as at nominal at the current rates. So that's where the transfer is. The wealth is in the purchasing power. And I don't know if that makes any sense, because I think a lot of people have troubles understanding what negative real interest rates really are.
Well, the purchasing power for our listeners, I mean, I remember 2005, 2006 when I was still in college. What a pretty decent steak at a restaurant costed me $15 to $18 maybe, and now, Gordon, when I go out, a good hamburger now at some restaurants costs almost that much money. So I mean, compare steak versus a steak dinner versus a hamburger and fries. So people might not think it like that. It's the evil greedy company that the restaurant's raising the prices. It's all their fault. They're the evil greedy capitalists. But they're not thinking, the restaurant's costs, their electricity costs have gone up, their interest costs for borrowing have gone up, their input costs for their food have gone up, et cetera, et cetera. So these are something, that the average person, the person on Main Street, just doesn't understand. But those are great points there about interest rates. I mean, Japan has been doing this probably longer than anyone, at least on a consistent basis. And
has it worked?
No, it hasn't. But, I mean, they've still had enough technology there. The Japanese work ethic is hard enough to where their corporations like Honda and Toyota and Sony have produced enough goods or services to at least offset some of their inflation that they have, which is why, I think, the Keynesians who are saying deflation and this and that, in the long term, I don't think because of the intervention and the financial repression and other policies we're going to have, they're not going to allow full free market forces, at least at this point in time.
We no longer. I'll interrupt here, Jason. We do not have free market forces and haven't had for some time. Don't think for one moment we're operating any longer in a capitalist society or economy.
Well, we have pockets of them.
Pockets,
so we have
maybe.
We have certain industries like 3D printing or robotics or things like that or building an online business with e-commerce where there's not as many rules and regulations, and you can get the business up and running with limited amounts of capital, and you can hire employees in the Philippines or India to help you out for technical things and things like that. But yes, in general, I agree.
Mm-hmm.
So there's certain pockets of this, and the economy in Silicon Valley has just gotten so efficient. It's still managed to produce goods and services despite all these rules and regulations and lack of free market in a lot of things. So it has offset some inflation. But
what happens, Jason, in a capitalist society when you get free and open and you get competition? What you end up with as a consumer is you get more for less. The competition forces that to happen, and that's what's so good about it. But when you start to restrict it, slowly but surely, you get less for more, and that's what you just described in terms of restaurants and everything else. We've been in that mode, getting less and less for more and more for some time, and now we're at the point where we're getting significantly less for a significant lot more, and that is the problem, and that's because of the inefficiencies and the lack of proper investment, the malinvestment, if you would, that goes into the system. That happens because you can't price risk properly. And when you get these interest rates at low rates and negative rates, you're going to get these kinds of distortions. And then what happens is you don't get capital investment. 90% of all of the profits in the last quarter from the S&P 500 went into buybacks and dividends. Where's the capital investment? Where's the risk-taking that's going to give you more for less? It's not 90%. That is a broken system, Jason.
Yeah, I agree.
That says that they make more money by debt financing because they can write it off as a tax, complete write-off, then buying the stocks back and getting the earnings per share up and avoiding the dividend payout or reducing the amount of dividends but increasing the dividend percent. This is a destruction of capitalism, and that's what happens when you have a protracted period of negative real interest rates we've had right now. And you mentioned Japan. Japan's an abject failure, a total failure. And here we have right now in the bond market on any given day, if the Bank of Japan doesn't show up, there is no bonds that are bought. They are the total bond market for the biggest debtor in the world right now. So the biggest pension plan in the world is in Japan, $1.3 trillion. And what is it doing? It's selling its bonds from 60% down to 30% to buy equities. And matter of fact, it's just not the Nikkei that they're buying foreign equities. Talk about a currency war where they're actually trying to protect their store of value by having it in something other than the yen that they know, like 120, is going to look like it was expensive at that point in time, the way they're going to drive it down. And I don't mean to go on here, but this is what happens when you destroy the capitalist system. And I don't think these people that are controlling these Keynesians understand the damage that they're doing. This is incredibly serious. And, Humpty Dumpty is very tough to put back together when you break things like this. And that's what's going on, destruction.
Exactly, but the Keynesians don't care about the long term. I mean, Keynes laid that out initially, like in the general theory, he doesn't care about the long term. So the Keynesians have never cared about the long term. Whether their definition of the long term is 3 years out or 5 years out, they care about next month or next quarter, making the GDP numbers, look good.
I think Keynes said, in the long run, we're all dead.
Yeah, well, that's a bad attitude to have.
Well, it tells you something about the thinking. I'm not here to bash Keynesian economics, and though I'm not of that ilk at all. What I'm here to say is that the damage that we're having can be irreparable. The capitalist system is not the problem right now. It's tampering with it. And one of the core issues is the economic cycle that we go through, the ups and downs, is actually healthy. It forces a cleansing. It forces malinvestment out. But we can't have that anymore. The moment we even have any worry that there might be a recession, we start pumping again.
Yeah, I agree.
And
I think the rules changed.
That's dangerous. That's the danger.
I think the rules changed, Gordon, after Lehman was a sacrificial lamb and allowed to collapse in 2008. I'm not sure if the central planners and the people on Wall Street understood that there was so much contagion with the derivatives market, and that letting Lehman fail would basically start bringing almost everything else down with it.
And it would have.
So
It would have. And I think you're absolutely right. It was a shock, a surprise, and it shouldn't have been as regulators. They should have, and because all the rest of us clearly knew the amount of leverage that was going on out there. And by the way, Jason, it's worse today than it was at Lehman.
I agree. And the banks are even larger, right? They're even more too big to fail. They have a larger concentration of derivatives exposure, of counterparty risk, and a larger share of loans in the economy and things like that. It's just
absolutely the difference this time. And there are a number of differences, Jason, but this time it's global. Last time it was starting to go global, but the amount of leverage was really centered out of the major U.S. banks and certainly the European bank. But now it's all the way through the emerging markets. We've had, for example, $9 trillion in the last 6 years that's moved out of the United States in terms of carry trade. The vast majority has went into emerging markets to, in fact, fund growth, which has brought demand forward. And so what's happened now is all of a sudden the United States dollar is started to move up for a number of reasons. But when the cardinal sin of a carry trade is to borrow in a currency that's going to fall. Well, they felt the United States dollar was going to fall or weaken, but at least not strengthen. Now it's strengthened. You're on the wrong side. Your currency's weakening, but you've got interest rates payments. So now you've got to scramble to cover your hedge. So suddenly the dollar has not only been going up, but it's losing control and it's compounding itself. This is what happens when you start playing games like this.
Yeah, the speculators, part of the financial repression is that the Wall Street hedge funds, they've been able to try to do these interest rate arbitrage trades and very sophisticated leveraged carry trades, not just with the yen. A hedge fund manager, a friend of mine, told me basically almost every currency now with these high-frequency trading computers is being attempted to do carry trades with at one time or another. So that's why, there's just so much volatility. I think a lot of this volatility has been financially engineered. I interviewed some longtime commodities traders, Kevin Kerr, last week on our channel, and he was telling me a big move in the oil market, 10 years ago, 12 years ago, used to be $1 a day. And that was a big move in the oil markets. But now, because there's so much paper oil out there, there's all these extra hedge funds with trading computers and algorithms. They're trading against themselves, and these things are a more efficient way of manipulating markets, in my opinion, especially the paper markets and commodities, that now, the oil price is just falling like a rock. These computers can see the whole order book, and they just blow out the stops. So they see where everyone's stops are, with the on the charts on the support and the resistance levels, and they just blow out all the support levels. They did it with gold. They do it in overnight trading. They know the illiquid times. It's just ridiculous the amount of extra volatility that's been created in these markets, due to these high-frequency trading computers and the stuff that we've seen in oil. But
I know a lot of people that were in the managed futures business, made a nice living, and since the MF Global debacle, and the degree of high frequency trading and dark pools that's went in, they have went out of business. And I would say that the managed futures people is probably down 20 to 25% that have gone out of business here in the last 3 to 4 years. And but the volatility, I won't use the word volatility, the amount of trading that's going on in electronic trading, as you say, is of that level. But the damage that it does, because suddenly it's not capital that's being applied, it's games that are being played that force the capitalist investment decisions to be different. Right now with oil plummeting, Jason, what people need to understand is the liquidity impact of it falling is devastating. Right now, so the payments to OPEC, let's just use $70 an oil a barrel right now. Immediately, we have just turned off the switch of $316 billion. $316 billion of OPEC money is not flowing on an annualized basis to those countries because of the price that's dropped in oil. If you add in the non-OPEC, Russia, Oman, Norway, et cetera, it comes to about $500 billion. That's almost equivalent to taper. But it did taper. How long did we take to taper? About a year, a little over, to wind it down. We just flipped the switch. Now, unless oil bounces back up, but when we start to get down into 50, I was using $70 or lower.
Oh,
you still there?
Yeah. At some point, Gordon, it may go lower in the short term, but at some point now, in the next 3 to 5 years, because the global capex budget now for oil spending, there's no incentive now for oil companies to go out and look for more oil at these low prices. We're going to have a big price spike up to $120, $130 a barrel or more than too in the next 3 to 5 years.
If not shorter. Exactly, because we have this boomerang effect. Every time you get a sudden drop down, everybody's forced to stop on the capital expenses, to short or to move cash flow wise. They pull in their horns. We go through this cycle all the time, and usually about 14 to 18 months later, we get a spike the other way. And sure as God made little green apples. I don't even think it'll be out as far as you suggest. I think it'll be sooner in. But that doesn't mean that oil in the short term with a correction or so in here doesn't go lower. The damage, though, Jason, isn't in the oil per se. The damage is in the flows right now. This is so at such a dislocation to the global flows of money. Think of these OPEC countries. There's $316 billion. What do they do with that money? Well, it goes back into the capital markets. It goes into assets. It goes into bonds. What's underpinning that flow? It's going to stop. Not only that, most of these countries, they're now into deficits in terms of their fiscal budgets. They're going to have to sell assets because they use so many subsidies in these countries. I mean, oil in Saudi Arabia is $1 a gallon. I mean, you pay $11 in Venice or Vienna rather. So that's the level of subsidy. It doesn't. I mean, they don't produce it for $1, so there is a level of subsidy that they're coming down. So they will pay that amount of money. They're going to have to sell assets. We will sort through that, but that's what we're facing in the next 60, 90, or 120 days.
In your opinion, Gordon, do you think then that the oil price was a financial warfare type of takedown there against Putin by a combination of the Saudi Arabia and the U.S. government and Wall Street then to put pressure on the Russian ruble and the oil price, so Putin, because Russia is a higher cost producer than Saudi Arabia?
Absolutely, without question. I think this is the first financial war of the 21st century. The only thing that's went down faster than oil is the Russian ruble. And in spite of Putin trying to shore it up, he spent, something like $80 billion. He's now going to have to tap his gold reserves if he's going to keep it up, so he's backing off that. He tried to peg it. And that's why I think oil is going to go down further here, Jason, some speculation, until Putin cries uncle. This is a financial war, and it's not just in the element you described. We're using the $700 trillion swaps market, off-balance sheet swaps market. We're selling naked shorts, et cetera, to drive this down. He's got a tiger by the tail. And as you remember, the Cold War was won because, in fact, the United States basically put Russia into an arms race that they couldn't win, and they went broke trying to match it. They did not have the industrial capacity or the money to do it. And 80% of the budget in Russia is oil and energy and gas. And the United States has got to win this one because otherwise the whole underpinning of the petrodollar falls. It's not about gas and oil. It's about the petrodollar. And if the BRIC countries and the exchange with China, if they ever move off of a dollar exchange, we have $6 trillion US that are going to come back for claim. You want to know what hyperinflation is. So this is something that we're willing to sacrifice the shale oil industry in the short term as part of this gyration. But it's also going to do something else, Jason. It's giving the government the cover, because now we have clearly the global demand is slowing. That's been obvious for some time. But now all of a sudden deflation is unquestionably there. We're seeing it in Europe in a big way. It's starting to see deflation showing in the United States. So you're going to see Britain say, no, we need to defer. All of a sudden you're going to see the United States saying, well, maybe the rate increases are going to be a little bit further out. You're going to see certainly the ECB be forced into something here in the next 60 to 90 days. So we're setting the pins up for quantitative easing 4 sometime mid-2015. They won't call it QE4; they'll call it something else. But because we're trapped. There's no way out but to continue to accelerate the money printing right now. You have 75 million baby boomers, 10,000 a day retiring, and right now the underfunded pensions. At the state level, 4.7 trillion, federal 3 trillion, corporate. We're close to $10 trillion right there. And I'm not talking about the total entitlement programs of about $84 trillion. You've got to get interest rates down. They've got to go. I believe we'll see a 1% handle on the 10-year within 14 to 16 months.
Yeah, it looks like that way because the
government.
Did I just
shock you there?
No, actually, because I've been speaking with Rob Kirby for a while, and Rob Kirby has made those predictions that interest rates would continue to go lower, whereas all the people you listen to on CNBC or Bloomberg, interest rates have to go back up eventually. They don't understand
They don't know what they're talking about.
Well, they don't understand the math problem. They just look at debt to GDP ratio, but that's not what governments care about. The governments like Japan and the U.S. who are the most indebted, what they care about is being able to make the interest payments on the debt at all. They don't care about the principal. They know they can't pay the principal. So all they know is they have to keep moving the interest rates artificially lower and lower and lower because they know the debt's going to grow and they need to be able to afford just the interest payments on the principal.
If we got back to even normal interest rates that on the 10-year, we would within 5 to 6 years we'd have $1 trillion of interest payments on the debt. As opposed to 2 to 3, we couldn't even begin to manage that. The Federal Reserve and the government have got to not only hold interest rates, they've got to drive them down because we're growing the obligations on and off balance sheet at such a rate right now.
And Japan has an even worse math problem than the U.S. does. Japan can't even afford, I think, a 1% increase at this stage. So if interest rates rose 1% in the next couple months, Japan, I think about 100% of their annual tax revenues would go just to interest payments.
I wonder if anybody knows how to do arithmetic. This is not complicated.
Oh, they don't want people to know the arithmetic like that. They don't want you. If people knew that, people wouldn't buy Japanese government bonds. People wouldn't buy U.S. Treasuries. People wouldn't hold the currency, right? So they're going to intentionally make sure that people don't understand the basic math like that, right? I think that's my opinion. This is basically, we discussed this before we start recording. This is basically, though, it looks like global financial repression then. So that's the game plan for whether it's the U.S., whether it's Japan, and even the developing countries look like they may start to get into this too.
It's anybody who's got a fiat currency right now, which is pretty well the entire globe, is either engaged in it or being forced into it as a counter pressure. You just have no choice. It's your only way of in fact surviving. So a key part of it, I said, with financial repression, is not you have to have inflation, you have to have negative real rates, but the real part of it becomes the regulatories and laws of ring fencing your options, so that you've only got certain things you can do with your money, and in doing that you're taking on more risk. And so what's happening now is we're subtly, it's not even so subtly, passing controls that are all packaged in such a way that they're supposed to be for our protection, but they're not. And the most blatant one that I run into all the time is FACTA, which is the Foreign Accounts Tax Control Act. And so what's happening here is if you're an expat around the world right now, it's almost impossible to operate outside of the country. And it's not because of the United States rules. The rest of the banks, the compliance is so strenuous and so difficult and so predatory, they don't want you as a client. Try and live somewhere in the world where you can't get a bank to allow you to draw your funds on.
Yeah, I mean, most people aren't accepting Bitcoin yet. I mean, eventually, maybe in a decade or so, there will be more ways around this with Bitcoin and digital currencies or things like that, perhaps. But as of right now, Bitcoin's not ready to handle all the global financial transaction setup, especially with governments making it hard to do that, and even set up an account for Bitcoin with compliance issues there too. Hello?
Still there?
Yeah.
Some of these comments sound negative, and I guess they are when we have a government that's being predatory. But in actual fact, I am seeing better opportunities than I've ever seen the opportunities are phenomenal. And anytime the government starts,
Hello?
I can hear you. I don't know if you
Okay.
you can hear me. We're back together.
Yeah.
Okay. I don't know what's going on here.
We missed the last couple minutes of you.
Okay.
The last 2 minutes, yeah.
I was talking about FATCA, but I would make a point that right now as negative as some of my comments may sound, and they are because of the regulations that the government is imposing and the impact on capitalism. But I'm actually seeing better investment opportunities than I've ever seen. This is a phenomenal time. And when governments start to interfere in this way, it becomes easier to invest because they're easier to anticipate. Right now, when I say that they got no choice on the funding, but to drive interest rates down, that is gives you a pretty easy way to start investing when you believe interest rates are going down. And by the way, obviously, I'm very much in the minority on that statement.
Now, Gordon, as part of financial repression, we saw the Swiss Gold Referendum. I didn't really expect it would pass, especially when they started defunding it and making contributions through PayPal basically impossible, shutting it down. I thought basically once that happened, it was over. Even if they could convince a certain number of people, they were going to figure out new ways of either, coming up with destroying the voting machines, or saying they broke, or rigging the voting machines, or whatever type of scheme or something they were going to come up with. I think the Swiss Central Bank wasn't even supposed to campaign against the Swiss Gold Referendum, and they did it anyway.
They did it in a big way.
Yeah,
which tells you something of the fear that they had, because the preliminary polls were suggesting that it was relatively close, but when it went through at 77%, I was stunned. I mean, that is a solid win. And whenever I've seen that, Jason, my experience has been it says that one party was totally underfunded with campaigns, and the other one was overfunded. And it was just a media blitz, and that's effectively what happened in Switzerland. And the Swiss central bank was out every single day campaigning. It was every day in the papers was in fact why this is wrong for the Swiss people. They basically put the fear into the Swiss people that if they did this, they would lose jobs in Switzerland. Everybody was afraid of their jobs. But on the other hand, what's happening? They're increased the banks, the Swiss Federal Bank, from 100 billion to 500 billion in Swiss francs, trying to maintain a peg of 1.2 with the euro. Well, the euro is going to print more money, which means they're going to have to print more money. This is a problem that's going to get worse. Whereas if they went to some level of gold backing, the Swiss people would be far, far better off. Now, I don't necessarily believe for one moment the job losses would have been that significant.
Yeah, that's how China got a inflation problem with their dollar peg. I mean, the official China inflation statistics are low, but if you talk with people who live in China, their food costs have gone up every year. Their basic stuff that they need to survive, those costs are going up every year.
But in Switzerland, if they went to the gold back and removed the peg, their costs would start to go down because that currency would be one of the strongest currencies in the world. One of the issues we have right now, Jason, is they're debasing currencies. There's nowhere to go because you basically have a currency cartel. 90% of the world's trading of currencies in four currencies: the euro, the Japan, the sterling, and the U.S. dollar. Every one of those countries is bankrupt or entity has got serious issues. So they just play ring around the rosy of a debasement and printing. Where do you go? So you go to gold or silver, but we see the kinds of manipulation that's going on there. But the Swiss franc is not part of euro, as you well know. It's its own country. If it was an alternative currency, the money that would flow into there would be phenomenal. I would venture to guess there would be the strength of the euro, the Swiss franc would be so strong, and that testament is how much they've had to buy to keep it down in the last 3 to 4 years. It would be even orders of magnitude worth higher. I would suggest they would have the ability to pay the average person in Switzerland a certain amount a month on a monthly basis as a payout.
Yeah, it strengthened the Swiss franc, I think, in the 70s when the stagflation was starting and people were starting to panic before Volcker raised interest rates and defeated inflation for a while. I think a lot of money flowed into the Swiss franc, and the Swiss franc strengthened so much back then. It had a partial gold backing too. That I think the
it was law.
Swiss bank.
It was law.
That the Swiss banks and the Swiss government, they instituted a tax on any foreigner who was moving all their money into Switzerland, that they had to pay a fairly big tax, I think, on their bank accounts in Switzerland to hold their money there.
Well, now what's happened is the Swiss bank, the central bank, the debt that they're now holding on their books at 500 billion Swiss francs is 80% of the GDP. The only two countries in the world, China and Britain, that are slightly larger. So it's got a huge amount of debt that it doesn't need to have, and the reason they're doing it is the banks in Switzerland have levered up so large, in such a large way, with loans to Central and Eastern Europe. And any kinds of problems there or strengthening of the currency is going to put those loans at risk. That's the lock that they're in right now, and that's just bad management.
Exactly. The big question, though, Gordon, and I don't know if you or I or anyone else can answer this, is how long can the U.S., Japan, these other countries now that are doing it, how long can they keep the game going and get away with, worsening financial repression, drastically suppressing interest rates, manipulating gold and silver, doing quantitative easing or wealth effect programs to prop up asset prices, allowing the Wall Street banks and hedge funds to make obscene amounts of money on very risky leveraged asset trades that could potentially blow up the whole system with counterparty risk. How long do you think they're going to be able to get away with this? Indefinitely? 5 years, 8 years, 10 years? What's going to be the choke point there that, or what couple choke points do you think then could potentially stop this? Is it going to be the OPEC, the oil country, saying, you know what, we're tired of this. We don't want to sell our oil price in dollars anymore. Is it going to be the China and other G20s doing bilateral trade agreements with each other where they settle in gold? What do you think then is the end game for financial repression?
I think all the things you just described are on the horizon. Don't for one moment underestimate what central banks and politicians will do as things get worse. I believe right now they're in the elevated concern stage. They haven't moved to the panic stage, and I believe the beginnings of that is going to surface in 2015 as we start to realize and fully appreciate, you and I understand, that these policies are failing and failing badly. And what they will do is going to kick that can down the road even further. The clock that's ticking here against this is twofold. One, it's like Humpty Dumpty, the counterparty risk. There is going to be corporations, countries, sovereigns, whatever, funds that are going to fold, that are going to break somewhere in here out of nowhere. I mean, the history is replete with these kinds of situations. And what's going to start to break it is, and what's happening is global demand is slowing down at such a rate. And part of it, the reason is because real disposable income is not growing. We pumped enough inflation, hidden inflation into the system. The jobs aren't there. The compression in wage earnings that you're getting, we're not creating the demand from the consumer, and we have a global trap that's going on here right now. And we've had so much capital that's brought production forward that we can no longer fill. That is a reverse vicious cycle that's now unfolding right in front of us. And the amount of jobs that you see it right across America right now. It's the number one issue. So they can print more money, but how long before the jobs we get much more social unrest? We have over 50 million people on food stamps. 15% of America is living on food stamps on a daily basis. You want to know what food kitchens would have looked like in the Great Depression? They would be small compared to what we would have today. Right now we're papering it over, and we can paper it over for quite a period of long. I think, Jason, to directly answer your question, I had believed that it would be in a Q3 of 2015 is when we would run out of runway. Right now, I think that's sometime in 2016. But the way I've seen the central banks in the coordinated fashion they're clearly working with now as a cartel, they could push this out into 2017 or 2018. And in doing that, what you'll have is a potential Minsky melt-up. Because, as I said, this crumbling issue with pensions, this is bigger than the banking problem of 2008, these underfunded pensions, the entitlement program. The only way out of that is you got to print money, but you got to drive those asset prices up. So a stock market that goes up camouflages this problem even to a larger extent.
Well, and the asset prices can't also, Gordon, to your point about the asset prices, they can't be allowed to stay down low for a long period of time. They can only maybe stay down low for 6 months or 12 months because they're used as collateral and leveraged up for so many other trades and other things in the derivatives market and elsewhere, whether it's the banking system, the hedge funds, sovereign wealth funds, etc. So I really think the potential black swan here could be the dollar is getting too strong for the rest of the world. You have the developing world, right, which has debt in dollars. So if you're India, you've had to take out a lot of debt in dollars while your rupee currency has dropped a lot, and I guess Russia's kind of in the same boat, although Russia has more natural resources, but, you know, a low oil price too. So if the oil price keeps going down and the dollar keeps going stronger, we may have 2008 or worse temporarily, but then you're going to have the central bankers, you know, close down the markets maybe, or maybe they'll have conference calls for a week or something like a Bretton Woods, and they'll come out with a new plan to manipulate the markets and get them back up again, Juice.
Yeah, that's the end game is how this will unfold. You're absolutely right why they can't let them go down at any extent. The rehythification of collateral right now is the problem. We have a shortage of collateral. That's why we can't get the lending going, because you can't borrow money unless you got something to post. And that collateral has been used so many times and has been pyramided to such an extent, everybody knows that and everybody's nervous about it. And we get into the repo market, we get into the shadow banking system, which it says is worse than 2008. So that's a looming problem. And the United States dollar is a tenuous situation. Something will break. But when that happens, Jason, you're absolutely right. What will happen is, and you see it, the locks that they're now putting in and the collars that they're putting in, I hear just in the last week in a number of the markets, because what they're concerned about, and when it does break, you'll probably have things shut down for a week, 10 days, 2 weeks, and you'll have, it's like when Apollo went around the moon, and you were maybe may not recall, and everybody waited to find out if they were going to be all right when they came out of the other side, and the world held its breath for about 2 days there. And we'll go through something where the world holds its breath for 10 days as the world leaders convene to figure out what's going on. ATMs may be shut down. We'll all be in this panic, but it's when that happens, Jason, we're willing to give up things for stability that we wouldn't even entertain today. They need that kind of crisis to facilitate the kinds of things that may be in front of us. Hopefully they're positive. But what will come out of that will be a restructuring of the U.S. dollar, which is at least 60% overpriced right now, a rebalancing of many of the institutions. It'll be a new Bretton Woods, but it won't be Western-centered as it has been since the Second World War. So on the other side of that, we'll progress. The world will not come to an end. But if you can manage your investments and you can see how this might unfold as an insurance policy, there is going to be massive wealth transferred.
I agree. Yeah, there's definitely opportunities. If you go back and look through financial history, whether it was the Weimar Republic or other inflations, mass amounts of inflation or deflation, there was always amazing investment opportunities. Now, most of the people involved in markets didn't understand what was really going on, and most people did suffer financially. But if you really study things, the people who studied things did very well.
Exactly. It's the same today. Do not listen to the mainstream media. Don't listen to me. Go out and do your own reading. The Internet is a phenomenal tool. The information is there. Don't believe the government headlines. Go and get the reports and go through them and see if they make sense to you. And by the way, you'll quickly learn that they don't make sense.
Yeah, I mean, I think I just sent you an article from Mises where the government was stating its budget deficit, but they weren't counting a whole bunch of other things, and the spending actually, the amount of borrowing the U.S. Treasury is actually doing increased despite the public headlines that got put out.
Exactly.
So yeah, so I mean, they're playing games.
Jason, this is so consistent. It's every day. Just the other day we had how great retail sales were. To me, that defies logic. I took them and tore them apart. You see the seasonal adjustments? It is so far off the scale of anything they've ever done before. Well, it's so clearly a massive plug number. But how many people went and saw that? That's what happens when you dig inside.
Well, how do we know the retail sales? How do we know the retailers didn't give, no money down, don't make any payments for 60 days? Because I live in the one of the highest average median family income counties in the United States, Gordon, in Fairfax County.
It is.
And yeah, it's one of. I mean, 3 of the 5 are right outside the D.C. metro area because of all the government money. But anyway,
which is telling in itself, isn't it?
Exactly. The parasites. When I had dinner with Doug Casey here, there's construction cranes everywhere, brand new restaurants being opened up, and he was like, this whole thing's been built off parasites. But anyway, though, at the cell phone stores here, you go into the Sprint store, and in the richest average median family income Sprint store, one of them in the United States, you'd think that people would be able to put down $500 cash for a new iPhone or something like that, and the Sprint store is telling people up front, no big deal, you'll pay an extra $20 or $30 a month because you can't a lot of their customers can't afford to make payments for a brand new cell phone.
Exactly.
Upfront cash. So it's a big red flag. But I mean, the cell phone companies, right? They're booking sales, right? Whether they're using creative financing or not. The car companies are doing the same thing with subprime stuff. So I mean, it's just creative financing to goose the numbers for another couple of years going forward.
It's alarming, and I could bore you with stories the same as I'm seeing, Jason, in the real world and people coming to me. So when you take what do you believe your lying eyes or do you believe the government?
Well,
it's clear. So what you got to do is you've got to do your own homework, do your own beliefs, and you will see the opportunities. They're there, but they're typically not being presented to you by some wealth manager, by the way.
Exactly, because I mean, there's no incentive for a regular financial planner to get you to buy rental properties, to lock in a fixed rate mortgage and get a cash flow rental property in a city like Pittsburgh or something like that, or to go buy master limited partnerships in oil companies or things like that. They don't make high commissions off those products. And, having worked in the financial industry as a stockbroker and selling insurance products for a little while and things like that, it's a sales job, and you're basically taught to sell the highest commission products. And, you're supposed to have a fiduciary duty, but that's what the compliance departments and the team of lawyers are for at these big firms. So your fiduciary duty is not really a fiduciary duty. It's just to basically do and sell the highest commission products, and then the compliance department and the lawyers will protect you from getting your own pantsuit off.
Well said. I don't think most people really appreciate how the system truly works.
Well, exactly, Gordon. Well, they don't want you to know how the system works. They don't want you to learn Austrian school economics. They want you to believe what you hear on CNBC and Bloomberg and from Jim Cramer. And, give your money to your money manager. And if you do manage your money on your own, you're buying still mainstream products and things like that, like mutual funds, which, don't allow compounding or anything like that. They steal after fees and all these other hidden fees and stuff. They steal all of your ability to compound wealth.
Well, I hope I haven't frightened your listeners. My intent is not that. Is to balance some reality and maybe some incentives for people to really go out and do some digging. There's never been a time where it's more important to do your own reading and do your own thinking. You've got to turn those sound bites off. And it's really important, and it's critically important for your future, because there's no question in the next 3 to 5 years we're going to go through massive changes in our society globally. Hopefully we're going to come out of the other side better off for these sort of things. The imbalances in the world are so great that these adjustments are so long overdue. And this is all part of growing and developing as a world. But don't be a casualty, because you will be a casualty today if you don't get busy on this. and at minimum start taking out some insurance policies. And I don't mean by the classic insurance. I'm talking about investments that would act as an insurance.
Yeah, and our listeners, I think, Gordon, I don't think they're scared at all. I think that we've had on so many different experts. We've had over 250 experts on our channel.
Are they saying similar things to me?
They are. I think our listeners, though, are appreciative of this because they don't trust Wall Street and the mainstream media after 2008.
Either do I.
Yeah, well, I definitely don't either. Having, been told by people in the mainstream media, that you can't, I don't care how smart you are, you can't come on and talk about the gold market or silver market like this or things like that. No, thank you. We won't let you on. So it's just, I think the people who listen to your channel, people who listen to my channel, they're truth seekers, and, they realize that in order for them to make sound business and financial and investment decisions, they need to know more and be more educated, and they need to, they at least trust us from the point that, we're going through the numbers here and we're at least pointing holes that, well, this report says that or that report says that. Why is the government saying positively spinning this to where, this is a positive sales number for Christmas sales or something like that when it's really not?
It's because we're not selling something, Jason, other than we're just trying to find the truth. And when you watch shows such as CNBC, people need to understand that there's two groups out there. There's the sell side community and the buy side. And if you're on the sell side, you want to be on CNBC selling your product or your solution or whatever. If you're on the buy side, why would you want to be on CNBC? You don't want to let out your strategy of where you're investing, right? But it's really the buy side that are really sorting it out. The sell side are peddling a product. So you don't get I'm sure CNBC tries to balance that. But if you're on the buy side, why would you bother going on? It's not going to help you in any way.
Yeah, and there's also the large banks and mutual fund companies, with their bond funds and stock mutual funds. Those are where the majority of retail money goes. So anything that upsets that apple cart, they're not going to want. They're not going to want people advertising that, your fees are going to be too high for these funds and you shouldn't buy any of them because they'll stop you from compounding wealth, or these are poorly designed funds that are not diversified even though they claim to be, and things like that.
I think people need to consider, as you said earlier, Jason, that the investments today aren't only in the securities market, that is stocks and bonds. There's this, I believe people have fallen into the trap of saying that's the only thing that's available. Investments are broad-based, but then all of a sudden you're so used to saying, well, I don't know who to do that with. It's easier to buy something on Schwab or Fidelity, or somebody says, here's what your portfolio of these assets should be, assets being stocks or bonds. But I would argue that that hasn't actually worked very well for the last 10 years. If you really were in a buy and a hold strategy, but there's huge numbers of investments outside of that domain that don't get the kind of visibility, and I think we're moving into an era where those are going to be front and center, my opinion.
Yeah, I agree. There's definitely more value there because there's not as many hedge funds or Wall Street analysts covering these things.
Well, they're not interested in them. There's so many baby boomers retiring right now, and I call them dirty businesses, that they've had great cash flow, but the kids have some Ivy League education. They don't want to be involved in this dirty business, and somebody's got to run it, but the parents have got to get the money out of the business somehow because they're just running out of age. They're getting too old. And try and get the finance and get somebody to run it. It's a bear.
Yeah, and there was also a peer-to-peer lending before Lending Club went IPO. Someone could go give their own collateralized loan. They could go do their own due diligence, and they could get a good return on their capital there. With Prosper or Lending Club for peer-to-peer lending. So there was those opportunities, although now, hedge funds know about them, and now they're going, now they've gone IPO, or at least one of them has. So now kind of that secret's out, but that was like a small secret to the person on Main Street, the smaller guy who could do things like that. So there are options available, but people are going to have to do more research or due diligence than they would, like you said, to normally just go and look at an ETF or an individual stock that's on the main market, where there's, this enormous amount of global asset price inflation and hedge fund managers doing crazy things long or short the stock or something like that.
Investing has always been a grueling and difficult process, but in the last few years, when we got to ETFs and everything else, we've made it so easy. And when anything gets easy, Jason, that's always a sign that there's a problem. Making money is not easy. It takes hard work. It takes some element of risk. And if it's just going to be, somebody told me to buy this, you're usually going to lose money.
Yeah, I agree. Although the technology entrepreneurs, Gordon, maybe it's because of all this cheap money from the Fed and other stuff. A lot of these technology entrepreneurs who have made their company in their garage or their dorm room, they've made it look very easy. Guy like, Facebook went to $1 billion company in only a handful of years and things like that. And there's countless other examples.
Yeah, there are. Those are good examples. There are so many, and how they find their funding or whether you can participate in their funding. But I go into all sorts of buildings, and I find groups of young people busy working on projects that in some way have the internet. And a lot of them don't need funding, or they have self-funding, or they're minor amounts of funding. They're there. There is a lot of entrepreneurial work going on in America and around the world. And this is where, and that's just not technology. I'm talking about people that are doing things in agriculture. I'm talking about people that are doing people in various services that are being created. A lot of them are being forced to do this, Jason, because because of downsizing, being laid off, etc. And they're being forced to find these opportunities. They're not big groups, but they're there. So there's investments there and there's opportunities. It's a new America, and it's not unique to America. I see it in Europe. I can't comment on Asia as much, but there's nobody more entrepreneurial than the Chinese people, so I'm sure it's there too. So that's where investment is today. That's the thinking you have to have, as opposed to what's trading on the stock market.
Yeah, I would definitely agree.
I'm just trying to open our listeners' eyes to a wider perspective. That's all I'm trying to suggest here. I'm not trying to badmouth stocks or bonds, because there's money to be made there too.
Yeah, especially with this drop in oil prices, I think it's while people are panicking and Wall Street is dumping oil and analysts are down, mainstream Wall Street analysts are downgrading all their oil stock recommendations and things like that. I as a contrarian, as a value investor, I think there's a lot of opportunity there if people do their homework in oil. There's a lot of really quality companies that can make money in this price environment that are getting indiscriminately sold and thrown out with the bad companies.
Precisely. There are. Now, when you have this kind of dramatic shift in pricing, a lot of very, very good companies get hit hard. And if you know who they are, then that's the time to be a buy and hold.
Exactly. Now, Gordon, I want to wrap up the interview here. We're over an hour. You and me enjoy having these discussions. I think we could talk for a couple hours. But I want to thank you again for your time. And please tell our listeners where they can find your work and your YouTube channel.
Yeah, thank you very much, Jason. Enjoyed the conversation. Yes, I have a YouTube channel. You can Google it, Gordon T. Long, website, etc. We do writing, we do interviews and video with experts. And we do them, Jason, not to make money. We do them as our form of investment research. So I talk to all these people. I've been doing them in financial repression, trying to get how they understand the problem, what they see the problem to be, what they're doing for solutions, what they're investing in, how they're investing. And I let the public listen to them the same way as I'm listening to them. And I use them as guidance to invest my personal money.
Sounds great. And I do, like, for listeners out there not familiar, I think I've said this before last time I had you on, I watch almost all your videos, and I've been watching them for about 1.5 years, 2 years. So I don't know if I've watched all of your videos on your whole channel, but I've watched most of them, and I think they're a really great piece of content. You're doing the world a service by providing an alternate view to the mainstream media, which is, I think, important to people out there who are managing their own money and don't trust the people in power anymore.
Thank you very much. We'll talk to you again.
Yeah, I definitely will.
Appreciate it. Thank you very much.